Welcome back to the Deep Dive. Today we're really digging into something fundamental in the digital asset world. It's this contrast between short-term speculation versus actually building long-term, maybe even generational wealth. Yeah, our sources are suggesting that, well, most people are glued to the daily price swings, chasing volatility. But the argument is that real wealth, lasting wealth, comes from ownership of the actual systems, the rails, the network, basically owning the infrastructure, not just riding the waves. Okay, let's unpack this idea that wealth is measured by ownership, not volatility. Yeah, and it's interesting, isn't it? Because it's not exactly a new idea. Think about historical parallels, like a gold rush. Are you panning for gold, speculating? Or are you the one selling the shovels, owning the infrastructure? That's the core difference. And the source material really pushes this idea of accumulation. Just quietly, steadily stacking assets that represent like equity in these foundational systems. It shifts you from just being a player in the market to being, well, a co-owner of the foundation, right? Like the early internet pioneers.
Yeah.
The big winners weren't always the day traders flipping .com stocks. Often, it was the folks accumulating the boring stuff, relatively speaking. Bandwidth, fiber optic cables, key domain names, or building the essential services, the search engines, the e-commerce platforms. They weren't just chasing quick profits. They were accumulating leverage.
Exactly. And that brings up a really important tension the sources highlight. Building infrastructure. It's often slow. It's not glamorous. You don't usually get those massive speculative pops. And let's be honest, early infrastructure projects can be incredibly risky, very volatile initially. So that kind of contradicts the simple avoid volatility message sometimes. This builder's mindset, it really demands patience, serious conviction. You have to believe the underlying utility will eventually win out over all that short-term noise.
Okay, so theory is one thing, but we need examples, right? To make it concrete. The sources we're looking at use a specific case study here. The Metallicus ecosystem. It's designed to be the core of something called the digital banking network, or TDBN. And the argument is, owning assets within this ecosystem is like holding, quote, equity in the new digital economy, precisely because it targets regulated finance.
That's the key point. It's not just about owning any token. It's about owning a piece of a very specific financial operating system. The source argues that every single token, every subnet they build, every partnership they forge, it's all adding another layer, an interlocking piece in this compliant, institutional-ready network. It's moving from just, abstract tech talk to actual, tangible financial capability.
So if we buy into this idea, this premise of accumulating ownership in the rails, well, what do these rails actually look like in practice? Let's get past the theory and look at the architecture. The sources break down 5 core assets that make up this core engine of TDBN. To really get the argument, I think we need to understand what each piece does.
Yeah, and what's fascinating here, as the source points out, is how they're designed to work together as a stack. They're not just like separate projects thrown together. The idea is the whole is much greater than the sum of its parts.
Okay, let's start right at the bottom then. The foundation. That's the Metal blockchain. Metal. The source calls it the layer 0 infrastructure. Now, for listeners, layer 0, that's like the absolute bedrock, right? The concrete slab. It's the base layer of trust and security built specifically to support other protocols, layer 1s, and critically regulated subnets. Why is that regulated subnet part so important?
Well, that's the big differentiator, isn't it? It signals compliance first. By building on a layer 0 that's designed for regulation from the get-go, they're trying to sidestep a lot of the headaches. The security issues, the jurisdictional problems, stuff that traditional finance, TradFi, runs into when they try to interact with typical public blockchains. It's meant to be a dedicated high-security backbone for them.
Okay, makes sense. So moving up that stack, what's next?
Next up is the XPR network. If Metal is the deep infrastructure, the bedrock, then XPR network is more like the utility layer sitting on top. It's identified as the main hub for DeFi and payments within this whole ecosystem. This is where the decentralized finance apps, the actual transaction flows happen. It's meant to bridge the gap, connect the traditional banking world with the crypto world seamlessly.
All right, infrastructure, then the DeFi payments layer. What about stability? That's always a huge concern for institutions.
Exactly. And that brings us to XMD. This is defined as the compliant stablecoin standard for the network. The source really emphasizes that its architecture is built specifically with U.S. credit unions and fintechs in mind, meeting their stringent requirements. So this isn't positioned as just another algorithmic stablecoin or even a standard collateralized one. The whole design focus is regulatory acceptance, getting banks and credit unions comfortable using it at scale.
That regulatory focus seems absolutely critical. It basically defines who can or will use this thing. Okay, pillar 4.
Pillar 4 is the MTL DAO. DAO, Decentralized Autonomous Organization. This acts as the governance and treasury power for the whole network. In any big infrastructure project, you need control, direction, decision-making. The source explains the DAO is there for community steering and managing the funds, allocating resources for future development. Think of it like the network's shared executive board, but, decentralized.
Got it, governance. And the final piece.
And finally, number 5 is the loan protocol. This is where the more sophisticated financial activities happen. Borrowing, lending, yield generation, that kind of innovation. It's essentially the economic engine. It creates utility, provides incentives, and makes it a more complete financial platform, not just a payment rail.
Okay, let me see if I've got this. We have the compliant Layer 0 Metal, the DeFi Hub XPR network, the regulatory focused stablecoin XMD, community governance MTL DAO, and the lending engine, loan. Put them all together. And that's the vision, the full stack, bank-ready ecosystem the source talks about. It feels cohesive.
That's exactly the argument. It's presented as a coherent system, and that connects back to the accumulation strategy. It's not about just buying a token hoping it moons. It's about acquiring sort of proportional ownership in this whole interlocking system. The source calls this the builder's mindset, focusing on stacking value, not just flipping coins.
It really is a different way of thinking, isn't it? Requires a psychological shift. Instead of obsessively checking the price, you're, I guess, watching your token count go up, maybe slowly, and seeing that as acquiring more shares in this compliant infrastructure. But let's play devil's advocate for a second. What about the risk? Infrastructure takes ages to build. Doesn't early ownership mean potentially sitting through years of uncertainty, maybe even failure? How does the source tackle that?
That's a fair point. And the source links it back to regulatory adoption as the key validation point. It highlights that this isn't just a theoretical project on a whiteboard. The claim is that the groundwork is actively being laid. Alignments with actual U.S. credit unions, discussions with regulators. They frame it less as pure tech speculation and more as accumulating bits of real-world infrastructure that's designed for near-term use by traditional finance. The idea, I suppose, is if real institutions are starting to build on it or planning to, the long-term utility becomes more tangible, reducing that purely speculative risk over time, theoretically at least.
Okay, and this is where, as the source puts it, it gets really interesting, looking at the future vision, the justification for that long-term patience. The source is pretty explicit about some massive goals embedded in this infrastructure plan. 3 big areas that could really change banking.
Yes, absolutely. They lay out a roadmap that includes, first, dedicated credit union subnets. So tailored blockchain environments just for those institutions' specific needs. Second, actual bank-issued stablecoins running securely on this platform. Not just XMD, but potentially branded stablecoins from banks themselves. And third, this is a big one, AI-integrated financial identity services built right into the rails.
Okay, AI-integrated financial identity services. It sounds a bit like buzzword bingo.
Mm-hmm.
What does it actually mean in terms of infrastructure?
Well, the source explains it like this. Financial identity is already critical, right? Think KYC, AML checks, fraud prevention, even things like credit scoring. That's all identity verification. Integrating AI for these services directly at the infrastructure layer means any future financial product built on these rails could potentially have compliant, intelligent identity services baked in automatically from day one.
Ah, I see. So it's about embedding the regulatory tech deep down.
Precisely. And the implication, according to the source, is pretty profound. If, or perhaps when, this vision unfolds when banks and credit unions are using these dedicated subnets, issuing their own stablecoins, relying on these integrated AI identity checks, then those who accumulated the foundational assets early, they won't just have more tokens. They'll effectively hold ownership, like equity, in the very digital foundation of modern banking and finance. They'd benefit from the utility generated by every transaction, every stablecoin issued, every identity check.
That ties right into this idea of the network effect of patience. How accumulation, as the source says, can be subtle at first, then exponential.
Yeah, the comparison to the early internet pioneers again, it's quite apt. Think about them accumulating things like IP address blocks, or really good domain names, or core network capacity, assets that probably seemed minor, maybe even unnecessary to many people back then. But when internet usage exploded, those seemingly small footholds became incredibly valuable leverage points. Owning a piece of the essential infrastructure paid off exponentially.
It really boils down to a simple causal chain, doesn't it?
Yeah.
The source lays out this logic for how value emerges in these networks, and it's worth remembering. Price follows utility. People pay for things that are useful. Utility follows adoption. Things become useful when people actually start using them. Adoption follows infrastructure. People can only adopt things if the underlying foundation, the infrastructure, is there to support it.
Exactly. And if you accept that logic chain, price, bound utility, bottom adoption, infrastructure, then the argument becomes pretty compelling. Accumulating the infrastructure assets now is the necessary first step to eventually capture the value when utility and adoption kick in later. And this model, this logic, it arguably applies beyond just banking solutions like TDBN. It could apply to any foundational Web3 protocol, storage, computing, data oracles, you name it.
And sticking with our source material for today, the conclusion they draw is very direct. Metallicus is the infrastructure, in their view.
Yes, summarizing that long-term focus, the sources really project a future where pretty much every financial institution, from your local credit union right up to global fintech giants, will eventually use tokenized assets, their own branded stablecoins, AI-driven services, and all of this will be running on compliant, dedicated subnets like the ones Metallicus aims to provide.
Yeah.
This isn't seen as just some niche crypto thing, but as the future standard for how finance operates and settles.
So wrapping this up, what does this all mean for you, the listener? Thinking beyond just this one specific example, it really presents a challenge, doesn't it? To shift your focus, maybe away from the dopamine hit of short-term trading towards the, let's face it, sometimes less exciting, quieter discipline of long-term infrastructure ownership. The source frames every XBR, metal, XMD accumulated not just as a token, but as, quote, another brick in the financial architecture of the next century. It's a call to be a builder, not just a trader.
And that brings us to a final thought, maybe something for you to mull over, building on this theme of ownership. If accumulation is the foundation of wealth in this digital age, are there other crucial digital building blocks out there, beyond specific project tokens? What other foundational pieces of the decentralized landscape might we be overlooking because we're so focused on daily price charts? Could it be governance rights and critical protocols, ownership of key data feeds, stakes in foundational computing networks? The provocation is really to evaluate potential ownership versus just daily volatility across everything you're looking at in this space. Try to identify the rails wherever they might be forming, and consider if having the patience to see the utility emerge is the smarter long-term play.